Most Canadian dividend investors pile into VDY for monthly income. But here's the problem with that. It's heavily concentrated in just a few sectors, a few stocks. That means your safe income ETF might be taking on more risk than you realize. Today, we're breaking down its biggest competitor, XEI. On the surface, it looks like its twin, similar yield, monthly distributions, but under the hood, it's built very differently. And that difference has a real impact on your risk, your diversification, and your long-term returns. In the next few minutes, I'll show you exactly what's inside XEI, how it's actually performed over time, where the income really comes from, and the key risks investors miss, especially if you're comparing it to VDY. Let's do this! Let's start with the foundation, because once you see what XEI actually holds, the rest of its performance will make a lot of sense. Before we look at the returns, you need to understand what XEI actually is, because that explains everything. Here's a high-level overview. XEI is the iShares S&P TSX Composite High Dividend Index ETF. This ETF focuses on Canadian companies that are characterized by high dividend yield. It currently holds 75 stocks. It has $3.7 billion in net assets and was launched in early 2011. It has monthly distributions with a current yield of 3.7%. It's rated as medium risk, with expenses of 0.22% for its MER and 0.01% for its TER, for a total cost of 0.23%. This is the direct competitor to the most popular high-yield income ETF in Canada, VDY. You can find all this information on the main page of XEI. There you have quick access to all the important literature. A 3.7% yield sounds great, but if total return isn't there, it doesn't matter. So how has XEI actually performed? Here it is. XEI has an average annual return of 9.2% since inception as of March 31st. That's impressive over 15 years. It is trailing its benchmark, which is the index it directly follows, by 0.33%, which gives us an idea of the tracking error after removing the 0.23% expense. It has performed well the last 10 years at 12.2%, the last 5 years at 16.1%. What really stands out is that 3 and 1 year average annual return, 19.6 for the 3 years and 39.5 for the last year. That's just phenomenal. We'll see why in just one moment. Holding this since inception would have a cumulative return of 275%. It's trailing its benchmark by 18%. That's what compounding ETF costs will do, and why it's important to try to keep these fees as low as possible whenever possible. To achieve any of these returns you see, you would have had to buy at exactly those time intervals. See this calendar year performance? 2021 was a standout year after the COVID scare at 35.7%. And the bear market of 2022 was actually a positive one for XEI at 0.5%. 2018, 19, and 25 were also very strong years in the mid to high 20s. 2018 was a down year at negative 10.8%, and 2020, negative 7.6%. Looking at the ETF facts, XEI's best 3-month performance was 17.1%, ending January 31st, 2021, and the worst was negative 27.4%, ending March 31st, 2020. Those returns look strong, but they don't mean much without some context. So how does XEI stand up against the broader TSX? Annualized 10-year returns are nearly identical, but the calendar years are quite different. Just as an example, in 2025, the TSX Composite returned 5.5% more than the high yield index. In 2024, it returned 6% more. In 2020, it returned 13% more. However, things flipped. In 2022, the high yield index returned over 6% more. In 2021, 11% more, and in 2016, 7.5% more. What may have looked like steady returns by average annual returns were all over the place in actuality. We can see that in the annualized 3-year rolling returns, from negative 5.3%, way worse than the TSX Composite during COVID, to positive 21.5%, better than the TSX Composite in 2023. Rolling returns over various time periods help us to see that timing has a large impact on our personal returns. This is why it could be to our detriment to focus on just isolated periods of performance when evaluating past performance. Quick thing, guys, before we continue. If you're new to the channel, I'm Mr. Financial, and I help DIY investors like you understand ETFs and investing principles so you can invest with confidence, not based on social media hype. If that's your vibe, subscribe. And if this breakdown is helping you see these ETFs differently, smash that like button. It helps out the channel reach more DIY investors. Now back to the video. So what's actually driving these returns? To answer that, we need to look at the factor profile. Here is XEI's Morningstar factor profile. Did you really expect it to look any different? It's loaded high on yield and low on quality. I personally expected it to lean into value, so no surprise there. What I didn't expect was the momentum range to go from low to high in the last 5 years. I think once we look at the holdings and sector breakdown, that will explain it. And XEI has low volatility and liquidity, but let's be honest, most Canadian investors aren't here for factor exposure. They're here for income. XEI is a high dividend ETF. It's known for its passive income for Canadian investors. It pays monthly distributions of 11.7 cents currently and yields 3.7%. If you look back over the years, most of the total return has still been from capital gains in spite of the high yield XEI screens for. The distribution started at just over 5 cents back in May of 2011. That makes for a compound annual growth rate of 5.7%. Inflation over that time period was just 2.3%. XEI is beating it by a long shot. The 2025 distribution characteristics of XEI are important outside of a tax-sheltered account. You'll have to go to the Tax Information Center of the iShares website for the most current year. In 2025, the total distribution was $1.95, of which $1.24 was eligible dividends and 68 cents were from capital gains. There was a small 2.8 cents foreign income in which there was an even tinier 3% foreign tax paid. That high level of eligible dividends makes this distribution fairly tax efficient, especially for low income earners in a taxable account. So we know XEI has had decent performance over the years and is fairly tax efficient with its distributions of mainly eligible dividends. So if you're buying today, are you overpaying? To answer that, we have to look at its PE ratio, or price to earnings ratio. The current PE ratio for XEI is 15.9. Compared to the TSX Composite Index at 20.2, this seems reasonable. However, as we noted when looking at the factor profile, XEI leans into value without trying to screen for value stocks. That's the nature of a high yield index. Something to remember when looking at the data on performance, distributions, value, and so on. These are all backwards looking metrics. We don't know what the future will hold. Not a DIYer like myself, or the professionals that live and breathe the market 24 hours a day. And valuation only tells part of the story because any ETF's performance is driven by what it actually holds. It had a phenomenal 1-year return of nearly 40%. So let's see what holdings were driving this return. What do you think it was? XEI holds 75 stocks using a full replication index strategy. Remember, the index XEI is following is the S&P TSX Composite High Dividend Index. The top 10 holdings are exactly the same as the index and make up 46.4% of the fund. This is a lot less concentration than VDY for those curious, and that has to do with the index construction. More on that towards the end of the video. The heaviest weighted stock is Suncor Energy. The top 4 are all energy stocks, and the next 4 of 6 to round out the top 10 are all big banks. Bank of Nova Scotia is currently sitting at the 11th spot as the last of the big 5 banks. There is also one stock in the utility sector and one in materials within the top 10. And this is how those top 10 have performed over the last year. That explains a lot of the recent performance I mentioned earlier. This is where that concentration risk starts to show up. Even with 75 stocks, it's not as diversified as it looks. The top 25 make up 80% of the fund. And look at the bottom 20. They don't even total 3%. If you were to calculate the effective number of stocks, you would see this is a lot less diversified than the 75 stocks suggest. This is typical with indices like the high yield index. I'll explain why in a second. So how does a top-heavy ETF like XEI look when examining the sector exposures? It may surprise you a little that both energy and financials are around 30%. Now, if you're familiar with VDY, this should already look very different, and there's a reason for that. I'll explain later. The next largest sector is utilities at 13%. All 11 sectors are represented in XEI, though the bottom 4 don't even make up 3% of the fund and are pretty much negligible, similar to the bottom 20 stocks in the fund. XEI is 100% Canadian high yield exposure, but don't let that fool you into thinking this is a simple dividend ETF. When we look at the Morningstar style box, we see why the factor profile is leaning a certain way. XEI is technically a large cap value fund. 41% is large cap value, 29% large cap blend, and 1% large cap growth. It's then 14% mid cap value and 9% mid cap blend. There's a little small cap exposure here too. Look at the end cap breakdown by Morningstar. Giant caps make up 43%, then large cap next at 25%, followed by mid caps at 23%. Even with just 75 stocks, XEI captures half of the total Canadian market with a total market cap of $2.5 trillion. This just highlights how much of the Canadian market is dominated by high yield companies. And looking at the index characteristics, the mean MCAP is 33 billion with a median at just 9 billion. After getting the fun stuff out of the way, it's important to know what risks have come with holding a high yield index like XEI. As I mentioned in the overview, iShares labels this as a medium risk fund. That means its standard deviation can be anywhere from 11 to less than 16. Firstly, let's focus on this volatility and some other risk metrics of the index. Focusing on the index annualized risk, its standard deviation was 14% over 10 years, 11.9% over 5 years, and 10.4% over 3 years. It has been dropping as the performance has improved. You see a good Sharpe ratio or analyzed risk-adjusted return of 1.92 over 3 years, all the way back down to 0.89 at 10 years. That standard deviation can be seen in all of its glory when we look at the nasty drawdowns of XEI over the last 10 years. It has had 4 large drawdowns of over 10%. The worst was negative 28.5% during COVID, ending in March of 2020. The other 2 larger ones were in 2022 and 2023. Generally speaking, you see that the TSX capped composite index was much less volatile to the downside. So even though this monthly pair has a decent standard deviation, it still has had a major drawdown, and these drawdowns take time to recover from. This is to be expected with XEI focused on one specific part of the Canadian market, high yield. Morningstar's risk score for XEI is 85, putting it in the very aggressive risk level. It has a high risk and return compared to the category. Its beta capture ratio over 10 years shows it's pretty flat. Nothing noteworthy there to mention. Lastly, here are some risk factors that the prospectus mentions. All of them are obvious, yet still do not ignore them. This is 100% equities, 100% in the Canadian developed market, which has its specific risk and is exposed to North American risks. For example, a decrease in imports or exports, changes in trade regulations, or an economic recession in any North American country may have quite significant economic effects on the entire North American region and on some or all of the North American countries. This will impact XEI. So why does XEI look different from VDY in the first place? This is where the index construction explains everything. It has to do with the S&P TSX High Yield Index versus VDY's use of the FTSE Canadian High Dividend Yield Index. The index is a strategy index consisting of 50 to 75 stocks selected from the TSX Composite, focusing on dividend income. The index is float adjusted, market cap weighted, with stocks capped at 5% and each sector capped at just 30%. The caps are established at the quarterly rebalancing and are not revised until the next quarterly rebalancing. The index rebalances effective after the close of the third Friday of March, June, September, and December. So that's the basics of the index when you invest in XEI and why it differs so much from VDY. To recap this deep dive, XEI is the iShares S&P TSX Composite High Dividend Index ETF with a yield of 3.7%, an MER of 0.22%. It pays monthly distributions of mainly eligible dividends and is considered medium risk with a current concentration of 30% in banks and energy stocks. Who may this ETF be good for? I personally think XEI is good or appropriate for a long-term holding, for long-term investors. It could be good for passive investors who are targeting a high yield on the Canadian market. It could be good or appropriate for a satellite position to accompany other core holdings. And VDY is appropriate for investors who can withstand the volatility that comes with a high concentration in Canadian banks and energy stocks. I don't think XEI is for you if you're not wanting exposure to specifically high dividend yield stocks on the TSX. If you're looking for a core holding, if you are a high income earner and will be putting XEI in a taxable account, there's tax consequences. And if you can't take the fast and hard drawdowns that have happened in the past, this may not be for you. And I don't think XEI is for you if you're trying to capitalize on some short-term price movements on the TSX. If you are looking at XEI, you are likely also looking at Vanguard's VDY. Check out that deep dive right here.